No, I think it's probably the resiliency of the asset class. We've been doing this since 2001, well before it became more of an established asset class. But over the last 10 years, really, the opportunity set established itself. Lots of new entrants have come in. A great deal of capital has come in, and borrowers' needs have been met by non-commercial bank providers of debt capital. So it's been great to see the evolution of the asset class from our perspective, but certainly over the last 10 years, that has grown, and even over the last 5, it's accelerated that growth to meet the needs of borrowers, both private equity sponsor and non-sponsor. I think that resiliency is really tied to floating rate. Folks don't have to take interest rate risk. Top of the capital structure is senior secured. There's minimizing principal loss. And I think at least with more typical lenders, bank lenders, an active, actionable loan document provides lenders the protections that they require in order to make sure that they mitigate risk and minimize principal loss. So I think it's the overall resiliency of bank debt in general, and I think the ability of the market to attract the amount of capital necessary to meet borrowers' needs have probably been the positives over the 21 years we've been doing this that we've seen in the asset class. So on concerns, I think it's probably many of the deteriorations of the areas I just touched on. I think I would start with the loan document. You've seen over the years the covenant packages and the limitations and restrictions on borrowers loosen up, and lenders becoming much more borrower-friendly. Many terms and conditions being dictated by the sponsor community in some ways. I think those are all areas of concern for us. The loan document and actionable triggers are part of the great hedge, if you will, of protecting investors' downside, which is so important in credit investing and lending. I think the amount of debt that's being provided, the risk profile, the risk appetite of the market is on the rise. We see record level of enterprise value multiples that's dragging up the key risk metric in debt, which is the debt leverage profile. Those are at record highs. The combination of weak documentation, record high debt levels, and leverage multiples probably isn't a good recipe for long-term performance. So those would be areas I'd be concerned with, it just seems to me that investors in today's credit world are probably taking on a lot more risk than maybe they would typically think in a bank loan fund. And I think they need to be aware and really focus on their manager selection in order to maximize return and minimize loss. Really, no. I think we pride ourselves in running a very diversified fund and focusing on a bottoms-up credit analysis to determine whether or not a borrower is worthy or not. I can probably tell you more of what we're not doing. Today, the most popular private equity sponsor target markets are healthcare, business services, software as technology, recurring revenue type of businesses. And since that's where the private equity community is going and spending so much time, many of the conventional private credit providers are also focused on those areas as well. That tends to have an overweight in these portfolios and less diversification. To be honest, we're not very competitive in those spaces when there's a lot of players focusing on it, or the sponsor world is demanding attention being paid to it. Because our strategy is primarily owner indifferent, we don't focus on sponsors, we don't just do non-sponsor, we really let the credit determine whether our level of interest in making the investment or not reside. The focus that the sponsor world has on those three end markets really hasn't driven our attention there, so it's left the playing field a little less trafficked in some of those other industries and those other sectors. And so we've been able to find opportunities away from where the general market has been seen most of the activity. Well, it's been quite a ride. Certainly our first 10 years or so, the dominant provider of capital in this space were the commercial banks, at least in the States. And that changed around the global financial crisis. Leading up to the global financial crisis, not only was commercial banks, but you saw a lot of activity from the hedge fund community as well in those last few years. Almost overnight, both of those providers of capital really turned their lights out. And it's really what laid the groundwork to establish the asset class today and allowed the space for the new capital to come in, the new entrants to come in. So in some ways it's different because the providers, the dominant providers of that capital have changed. But in other ways it's very similar because the behavior exhibited by the commercial banks, their focus on the private equity sponsor world, their focus on high deployment, high volume kind of lending, has really just been replaced by non-commercial banks and more of the conventional players of within the asset class. Today, over 95% of the money that's been raised and operating in the private credit market in the States has been raised in the last 10 years. So that most of those folks have had a very kind and benign credit environment in which to invest in. And I think folks have to ask themselves, do they think the next 3 or 4 years are going to be as kind as the last 10? We think not. We think that the last 10 years have been a great beta trade for private credit in the States, and that going forward it's going to be much more important on manager selection, once again, on differentiation in the market and a manager's ability to manage through volatile economic climates, underperforming credits, and really focus on principal preservation, because those will be the keys we think in the coming years, and it'll be very different than I think what investors have experienced over the last 10, which is really the basis for the asset class. I would reiterate really what I just touched on. I think that the manager selection of private credit has not been as critical, I think, over the last 10 years, given the wind at the back of investors, of credit markets in general. Flat to down interest rates, reasonable economic activity, very low default rates. It has allowed lots of new money to come in, lots of new entrants, and it's really condensed or bunched together performance. The ability to differentiate is challenging for investors. And I think that in the coming years, those traits around workouts, around bankruptcy, managing underperforming credits, and really focusing on how to minimize principal loss will be the areas that differentiate and allow the winners and the losers to be established in the coming years. So I think it'll be different, and I think the traits that are successful will be different, and it'll be more of the old school kind of lending characteristics, fundamental lending that will carry the day.